Maybe you could take us through, from the plausible theories to some of them which are bordering on fantasy. What do you think's behind this move up in gold?
This gold move has been fascinating for a number of reasons. We haven't seen a new risk event. We haven't seen a new catalyst that has triggered this rally higher, which in our view makes it more prone to corrections and makes price action likely to be more choppy. Typically, when we see a move of this magnitude, it tends to be driven by either speculative positioning in the first instance and then followed through by stickier demand, whether that's ETFs or physical demand, following through and pushing gold prices higher. So this move has been interesting because we had a small window this week where we started to see ETF inflows, but that has quickly disappeared and reverted back to outflows. Instead, what we have seen is a large increase in tactical positioning. And even then, positioning isn't at all-time highs. So there's still scope for further growth if we're looking at whether positioning is overcrowded, whether it's ETFs, whether it's coin demand, whether it's tactical positioning. At the moment, it isn't. But one key dynamic that has supported the complex is the fact that central banks have remained net buyers, and they have been so for more than the past year.
So what's perplexing is that we're seeing all these successive all-time highs, Suki, as you mentioned. Despite that, real yields are remaining elevated. The dollar's still strong, and even with the markets repricing and pricing out the possibility of cuts this year, gold continues to edge higher. So do those drivers, are they not as relevant now? What are going to be the key drivers to look out for?
With the gold market sentiment almost becomes even more important than some of the macro data releases we see on a week-by-week basis. And when sentiment is positive, we see gold's focus becoming much more fickle, and it will switch to following rate cut expectations and the timing, or whether it's safe haven demand and geopolitical risks, or whether it's inflation and whether inflation remains sticky and therefore gold can act as an inflation hedge. So at the moment, given that sentiment is so positive, it's really sidestepped any of these headwinds and only looked at what the positive factors are. But also, I think what is interesting in the current rally is that we're still seeing many buyers in the market, whether it's appetite in China, whether it's continued central bank buying, whether it's a tactical positioning, but we're not seeing as much selling as you normally would when you see prices at these sorts of levels. So we haven't seen a surge in recycling supply. We haven't seen some of the normal sellers or the physical market dropping off a cliff, even though prices are at all-time highs. Instead, volumes have come down, but we haven't seen a huge wave of selling counteracting that upward momentum.
Suki, to pick up on one of the things you just pointed out there, the demand coming out of China, what specifically are you seeing in terms of buying coming out of China?
So we tend to track a number of factors, looking at retail appetite, looking at the official sector appetite, and across the sector as a whole. And what we're seeing at the moment is that the Shanghai Gold Exchange premium remains relatively elevated, suggesting that underlying demand is still healthy. In January, we had record gold imports going into China, so overall appetite remains strong. Partially, you could have said that was the buying leading up to the Lunar New Year, but we did see a slowdown in the immediate aftermath of the Lunar New Year, but then appetite picked up again. And even when we look at central bank official sector buying, we had the March data released earlier this week, and China continued to add to their overall reserves, but at a lower volume. So what we're seeing at the moment is that there's a lack of alternative investments potentially that are continuing to buoy appetite in gold. So China is the one area where we're seeing a pocket of strength, where physical demand in other regions such as India across Europe is starting to weaken.
Okay, tell us about some levels that you're watching out for now, right? Because we briefly touched 2,400. I think maybe a few months ago, people would have thought that was crazy. What levels are we looking at now? How much more upside really are we talking about?
I think given the factor that this is not being followed through by physical flows or by ETF holdings that we can track, it's very difficult to track where that upside momentum might come from. And given it's much more choppy, we think that the upside at the moment isn't being capped, but the downside is being very well supported. So we think that the floor for gold, which hasn't really been tested, is still quite well supported at these sort of levels. So at the upside, we think at the moment that there's still scope for further growth. We could still see tactical positioning pushing prices to even yet higher highs, but it's difficult to call where that level might be just yet.
And how would you recommend playing gold at this point? Spot, physical, ETF, minor, whatever derivative, for example, Suki?
Given that we're commodity-focused analysts, it's difficult to say whether gold is a better product than, say, some of the stocks. But what we are seeing at the moment is that investors are much keener at the moment to invest in tactical positioning, and the ETFs are continuing to fall. So there's not as much appetite to invest in the ETFs. Coin demand has been very choppy as well, so maybe that retail demand has come off. But it does look like investors are not keen to short gold at these current levels. And there's a whole raft of factors that's buoying that appetite in gold. It's not just the expectations of rate cuts, but it's the continued uncertainty around geopolitical risks. So at the moment, there's appetite to buy gold, and at the moment, it looks like it's really coming from the tactical investor side.
And what's really, gold's really overshadowed what silver's doing, right? We were just showing those year-to-date gains, and that's actually in some ways outperformed this year when it comes to silver, Suki. I mean, obviously we've been waiting for this catch-up to happen, but, how much do you think silver should cost right now?
Silver is an interesting precious metal because on the one hand, it has the same drivers as the gold market. It pushes gold prices higher when we see a supportive macro backdrop, but also it has a huge industrial component. And when we look at silver from an industrial component standpoint, the outlook is very positive when we're looking at growth from the photovoltaic sector, whether we're looking at from electrification of vehicles, 5G network rollout. There's a huge potential of growth for underlying supportive demand growth for the silver market. But the investor side hasn't really been keen to catch up until now. And whereas gold ETFs have been lacking, silver ETFs have really picked up. So with the silver market, we think that we could see prices potentially extending their gains towards $30 per ounce. But we really saw this as a target that would play out over a longer term basis and not as quickly as it has done.
And Suki, just to build on that too, if you could talk us through a little bit more about your outlook for industrial demand for not just silver, if you could also mention things like palladium and platinum as well, if you could.
Looking at the sector as a whole, we were expecting a recovery when it came to both platinum and palladium, at least in the short term. When we look at some of the end usages, I think some of the demand trends hadn't necessarily filtered through for the PGM space because stocks were as elevated as they were. And abundant stock supply across the supply chain meant that even though when we were seeing a pickup in underlying car sales, that wasn't necessarily translating into stronger demand for the PGM space. But now I think we're entering a period where some of those stocks have been run down, and we're more likely to see a more direct impact on the downside support, at least for the PGMs, lifting the floor higher for both platinum and palladium. So we think that there is room for growth for both platinum and palladium, but we think over the longer term, i.e. beyond 2024, that's when some of the supply concerns will start to kick in for perhaps platinum, and we'll tend to see more upside risk for platinum. And then whereas for palladium, we think the demand will start to weaken, and we're more likely to see palladium surrendering its premium over the platinum market over the next few months.